you for everyone for coming. I know you've all got busy schedules and taking time out of your day, so I really appreciate that. For those who don't know me, I'm Vanessa Azzini. I'm the Director of Strategic Business and Accounting Solutions. We are a small boutique accounting firm which look after a range of clients, and we deal with not only just tax returns but a range of other advisory issues. So we give this business advice. We also help with self-managed super funds, tax planning, structuring, and bookkeeping even, so if you need that. We've got a really great relationship with Morgans. Our office is actually just in there and Morgans is at the other end, so it makes it really convenient. I've twisted David's arm tonight to come and give a brief overview over the proposed changes for the franking credits given the looming elections and what's been stated what will happen. I'll just have to read this, I'm sorry. David has over 14 years experience as a certified financial planner. He has worked in a number of businesses from large institutions to boutique advisory firms. David seeks to first understand his clients' goals along with their appetite for risk, and then based on this understanding provides tried and true strategies. So, thank you, David.
Thank you. None of that I deserved. Thank you for coming along. I want to make this as interactive as possible. Please, this is not a monologue. Please ask questions, please sing out if you can, because I'd rather, I don't want to talk out here for 20 minutes and bore you all to death. So please, please sing out if you do have any questions. In saying that, I will read every word of this general disclaimer. I will not. I will refer you to my more specific disclaimer, which is tax should never be the sole reason that you do anything. However, you know, if you're not planning well, you are probably paying more than you probably should, which is perfectly fine if you think it's being used well. That's my disclaimer, but that is the true disclaimer. What's franking credit? So again, I'll skip over this. I think most of the people in this room would probably understand what a franking credit is. So do tell me to slow down or skip over it if you've heard this stuff before. But the formal definition is up there. It's essentially a system to eliminate double taxation on company profits that are paid out to investors. So interestingly, it's been in place by Paul Keating. It was put in place in 1987, and Howard and Costello then changed in, I think it was the 90s, they changed it so that excess franking credits could then be paid out to investors. It was as is proposed. So it was back in 87, it was that once all franking credits were used up, the excess would not be paid back to investors, but that has since been changed by Howard. And these proposals are actually going back to the original, or to part back to the original law. Interestingly, Finland, Italy, Mexico, New Zealand also have dividend imputation or franking credits. The UK, Germany, and Norway, I think, all had dividend imputation systems at one point in time, but that has changed as well since they've changed their tax systems. The informal definition, like my more specific disclaimer, I prefer an IOU from the ATO.
So, do those four countries, do they pay you any excess that you don't use up against that?
That's an excellent question, and I don't know the answer.
I think the answer is no.
No, okay, so it's as it was in 87.
I think Australia is almost alone in...
Right. Well, that's certainly what Bowen's saying.
So does everyone know how they work?
Vaguely.
Vaguely? I'll skip, I'll go through it broadly. But essentially, if the company is pays a 30% company tax rate, and it distributes a $7 dividend to shareholders, there's your formula there. And essentially it means on a $7 distribution or dividend, there is $3 worth of franking credits. Now, depending on where that franking credit is paid to, means that you can potentially, under the current laws, get that back. So, if you're in pension phase, where it is presently 0% tax, you get both a $7 dividend plus a $3 credit. That is assuming that your dividends are 100% fully franked. Does that make sense? Partially franked is essentially the same thing, multiplied by how much franking is applicable. So a company can choose to pay 50% franking. So they can only choose to pay out 50% of their franking credits. So that essentially on the same scenario, the shareholder is only credited $1.50 in franking credits. So in total they would receive $8.50 instead of $10. Does that make sense? So the current system, this might be again a little bit oversimplified, but it's the easiest way I've found to describe the Australian taxation system. Marginal tax rate. So all taxes end up in basically 4 boxes. We can be taxed at our marginal tax rate, which is up to 47% plus Medicare levy. We can be taxed at a company tax rate, which is either 30% or 27.5%, depending. Small business is 27.5% and investment company is 30%. Super accumulation tax rate, anyone?
15.
15. And income stream from your superannuation?
0.
0. So if we're receiving franking credits of 30% in each of these above entities, and we are receiving excess franking credits in a 0% tax environment, we are essentially 30% better off. Does that make sense? Easy. So what are the proposed changes? From 1st of July 2019, and I think that's probably the most alarming part, from the 1st of July 2019, Labor proposed to remove the ability to claim surplus franking credits from investments and superannuation accounts. A surplus franking credit result when franking credits received from the dividends are greater than the investor's marginal tax rate. Franking credits can be still used to reduce income tax to 0. So if we go back here, again, if we're receiving franking credits at 30% and our company tax rate is 30%, we're still offsetting all our tax. But if we're in a 0% tax environment, we're not getting that 30% back. So in our earlier example, the $3 of franking credits, we're getting $3 here. This is taxed at 15%. We're getting $1.50 here. Here we're just wiping out our existing tax, and here we're actually paying top up tax. Make sense? The proposal means that those members with retirement pensions where the effective tax rate is 0 will not be able to rely on franking credit topping up the pension account balance, effectively reducing the overall return for the account. And we'll go through a couple of examples so we can see how that affects both on a dollar basis and a percentage basis the income received. What are the exemptions to this? Very little. ATO endorsed income tax exempt charities and not-for-profit institutions. And that is it. Again, I've just reiterated, it's proposed that the policy will commence from 1st of July 2019. It doesn't leave a lot of time.
To what? Time to what?
To prepare, plan, to adjust,
Right.
if it comes to pass.
Will the government, if Labor wins,
Yes.
will they need support from the Senate to get this through?
Yeah, absolutely.
So and what are the probabilities of that happening?
It's a good question, and I wish I knew. My personal opinion is that we'll see the gap is narrowing between the two major parties seemingly on a daily, weekly basis. The current crossbench do not support the policy. So if the current crossbench gets in, if we do have a minority government one way or the other, I think there'll be horse trading. And I think that'll probably be the first thing that is horse traded away, the start date. but that's my personal opinion, and I'm certainly not a political analyst at all. But that's my feeling. How does
So
everyone
that'll
else?
only apply to dividends paid after 1 July 19 if it's implemented.
Yeah, exactly.
Next
So
one.
we'll get franking credits up until that
until
date,
30
and then for the new financial year, all bets are off. But this is why we've seen BHP, Rio Tinto, Woolies doing all the buybacks and paying out, essentially doing their buybacks with very little capital return, but very high franking credit balances. They're getting their franking credits off their balance sheets. And these guys they're doing it for a reason, aren't they? So, who's impacted the most? Self-managed super funds. Broadly, particularly in pension phase, because if we go back, pension phase, 0% tax, we're getting all those franking credits come back as excess payments to the fund, which helps fund the pension. Self-funded retirees, self-managed super funds in pension phase that have received Social Security after 28th of March 2018. So for some reason, when the policy was formulated, or when it was actually announced, was the 28th of March 2018. From that date, if you were not receiving a Centrelink age pension, you're not eligible. In fact, when the policy was initially announced, this caveat was not in that policy announcement, and that was added, John, you might correct me, but 24 to 48 hours later.
Yeah, well, I think within a few days.
Yeah.
Pressure.
Yeah,
So effectively grandfathering at that moment.
right,
Right.
exactly.
Thank you.
Who won't be impacted? And by no means is this an extensive list. So self-managed super funds in accumulation phase will be impacted, because if the franking credits are coming back at 30% and they're taxed at 15%, they'll have some to offset, but they won't get that excess back again. Retirees who won't be impacted, retirees receiving the age pension on or before 28th of 3rd, 2018. Most members of the institutional superannuation funds, the industry superannuation funds, retail superannuation funds in pension phase. Why is that?
They'd still be earning income.
Well, if they're even if they're in pension phase, the fund actually does one tax return. So because they've done one tax return, and they might have 500,000 members in accumulation paying tax, and they might have 100,000 members not paying tax in pension phase. So they've got a lot more tax to offset. So that's the way that they're somewhat protected, and you know, that might be an ideological policy choice.
Is that the opportunity?
Perhaps. Partly. Self-managed superannuation funds in pension mode receiving a benefit on or before 28th of the 3rd. So if you're in pension mode but you didn't receive, if you were receiving a Centrelink pension on or before the 28th of the 3rd, you're not going to be impacted. Very, very low percentage of the population, mind you. A couple of examples. And tell me if I'm going too fast. If you have any questions, please sing out. It's SMSF with a $500,000 balance, single member fund, we're age 74, asset value of $548,000, and not eligible as at the 28th of March 2018. If the income received by the SMSF is $33,000, we're getting approximate franking credits of 11. So the total SMS income is 44. We only need 40,000. Excellent. Where the balance is going up. The capital balance is going up. We're only drawing 40 and we're making 44 because those franking credits are coming back to us. However, taxpayer is nil. Refundable franking credits is exactly the same. So if refundable franking credits are removed, we are suddenly losing $11,000 worth of income, or 25% of the total income for that portfolio. Where does that now come from? It comes from capital. So we now have a required capital drawdown to meet the annual expenses if the proposed rules are changing of 7,000. So we're drawing 40, we're only getting 33, we've got to draw out 7 of capital. So you can see how that's going to impact capital over time. And the next example will show that on a graphical basis. So example number 2, single member SMSF, age 74. Let's say just over $1 million in asset value. Pension eligibility is not applicable as at 28th of March 2018. And the annual pension payment is $51,000. If we are receiving income of 36 and we have franking credits of 6.5, we're getting a total income to the portfolio of 42.5. Refundable franking credits of 6.5, we are losing, that we now lose, we're losing 15% of the total funds income. It's significant, very significant. Required capital drawdown to meet the annual income needs. So you can see we're drawing 50, we're making 42 and we're drawing 51. So presently we're still drawing capital down of 8.5 grand per annum, but the additional capital drawdown, if the proposed rules pass, will be 15,000 per annum. Again, these are substantial numbers, because over time, you can see there in the red is the current situation, the blue is with the non-refundable. So you're talking about a difference between 75 and 90 of $200,000, thereabouts, in capital reduction.
Other than it's going to cost us money, is there any argument of unfairness about this?
Plenty, yeah. So I don't know if you've seen Jeff Wilson, who runs Wilson Asset Management. He's got an online petition. It might be worth looking into. But there's something like 40 to 50,000 signatories on that already. And they're lobbying pretty hard to get that to basically a stay of these rules, of these proposed policies. Yeah, but there's plenty of lobbying going on.
When you say unfairness, the contrary argument to that is the fact that the idea of franking credits is so there's no double taxation.
Yes.
The impact of this, of giving money back, so that the company pays the tax,
Yep.
and then the franking credit goes to the taxpayer,
Yep.
who then takes it off his tax bill.
Yes.
So he doesn't pay tax again. So,
Yes.
so it's strictly two lots of tax, he goes to one lot of tax. When you get it back, you pay no tax as in the super fund. Because the effect is you're giving back the tax that the company paid, therefore the company or the taxation department is getting zero tax. Not one tax, not two taxes, but zero tax, because you're actually giving back tax that the company paid in the first instance. That's the rationale behind this.
Yes.
So it impacts us as a loss of income, but as far as the Australian taxation office is concerned, it's a way of redressing the fact that tax should be payable on profits. This way, there's no tax payable on the profits that go to retirees.
Yes.
So that's the contrary view.
Yeah,
Impacts us in our hip pocket.
yeah,
The Australian public is better off of having tax paid, which is the argument we all endorse, saying companies should be paying tax,
absolutely.
and all the companies who are paying tax should be paying tax. This is a way of making the taxpayer, as a collective, collect some tax from the companies.
So I agree with that, absolutely.
So that's the contrary argument.
Yeah,
Where it costs us,
yeah,
but the Australian public gets what they deserve, which is one lot of tax against profits.
yeah.
Not zero tax.
Not zero tax.
Yeah,
But it does impact.
us.
Yeah, absolutely,
Yeah.
absolutely.
Yeah.
And this is probably a slide that, this is probably a slide more for from an accounting perspective. So if you have a company that, and probably alludes to what you were saying, if there's franking credits in your business, if you have a business and there's franking credits accumulated from the tax you've paid on your profits over time, then how do you get those franking credits out? Because typically what's done is once a company is close to winding up or winding down and there is no more active trading, so to speak, currently the franking credits can be paid out through distributions from that company. That will no longer be the case. So if you have $100,000, $200,000 worth of franking credits in your business, in your company business, the only way that can now be paid out is through a trust, which will, the other proposal will be that the trusts are taxed at 30%. You pay it out to the trust and the trust uses the franking credits to offset its tax rate. But again, no excess franking credits will be coming back to you.
So I'll just jump in. So typically what, as an accounting tax strategy, planning strategy is, you might have you've sold the business, so you might have, say, $500,000 sitting in the bank account, say, and you want to get that, you want to wind up the company. You can't wind up the company if you have more than $1,000 net assets sitting inside the company. So typically what we do is dribble that out over a number of years to a lower income tax bracket, so to a lower marginal tax rate. So someone earning, say, $20,000, or they might be retired, receiving a pension out of their super fund. So you might give them, say, a $30,000 dividend every year to get that money out. It has franking credits because they're on the lower marginal tax rate. They get the refund back. But now you've still got to wind up the company somehow, so you've still got to get the retained profits and you've got to get the cash out. It just means that you won't get those franking credits back. So it's sort of essentially a little bit like dead money in a way, that you've paid it to the ATO but you can't get it back because you're not going to be able to get that excess refund back.
Except up to the tax-free threshold.
Yeah, well, so it will offset. So if you're in, say, if you're earning $20,000, if the income's $20,000, you've got a $6,000 franking credit there. You're not going to get that $6,000 back in your pocket. It's just essentially dead and gone. But it's a way you can still pay out the dividends, but you just don't get those franking credits back. So you still, over time, be able to wind up the company without incurring additional tax.
Yes.
Does that make sense? So what strategies? I guess that's why most people are here. What strategies can we do? Particularly for self-managed superannuation funds. So there's a few theories around it. You could bring in members of, if you've got kids, they're in accumulation phase typically. You can bring in additional members, your children, into the superannuation fund as members of those superannuation funds. They roll their balances into the superannuation fund, which then pays tax, which can then be utilised to offset some of those franking credits. That's example one. And that's difficult, I know it's family stuff, right? But it does make your self-managed super fund more of an estate planning vehicle than it probably previously was, which is an important factor because these things can survive throughout generations if they're set up correctly. And that can be an important factor for some people. Can we switch to investments that do not pay fully franked dividends or partially franked dividends? Or can we switch to high yielding investments that aren't fully franked? Or should we throw the baby out with the bathwater and change investment strategies altogether? I've got a slide coming on each of those, or the last two, but just buying higher yielding assets isn't the right thing to do. You're typically going to be, the higher the yield, the more chance you could be in a value trap, which is, a value trap is something that's gone down so far that its previous yield looks high, and thus the further it down it goes, the more likely it is that it could possibly get a dividend cut. So you've got to be wary of the value traps. And that's what this quote basically says from Morningstar. The more risky, you might end up losing more capital than you've picked up as extra yield. As we see in equities all the time, high yielding stocks often just means that there is a dividend cut on the way. So don't move out of a stock due to just simply and solely to franking credits, which harks back to my specific disclaimer, don't do anything for just tax reasons alone. So I wanted to give you some examples of some of the stocks that you can invest in that aren't fully franked or are partially fully franked. But infrastructure is a really good example. Infrastructure, we've got APT, Spark Infrastructure, AusNet Services, Horizon, Atlas Arteria, Sydney Airport, Transurban, Bingo Industries. You can see down here, these are all still fully franked, but you've got here partial levels of franking, but they're reasonably high. Where are we? Income, cash yield, 5% and above. A little bit under, but you can get as high as 6.6 with not a lot of, you might, you're looking at the percent to target price. So our target price is our forecast share price in 12 months time. So you want to look at both the yield and the target price or percentage to target price just to consider it and weigh these things up with the overall portfolio. Absolutely. Because there's no way you want to go 100% into one stock. The other one is Australian Real Estate Income Trust, AREITs. So I've included a few here: Aventus, BWP Trust, which is Bunnings Warehouse, Uniball Redemco Westfield, used to be Westfield before it was taken over by the French giant, Centuria, Arena, Viva, Energy REIT. You can see the ones we've currently got an ad, but you can also see the distribution yield. So we're talking about averages of 5.9 to 6.3 and even as high as 7.3% yield. So when you typically look at Australian stocks, broadly, you're getting a yield of 4.5%, but in this AREIT space, because and none of this is franked. But you can see why a lot of people have probably moved in this area already, because they're all relatively, they're at high prices at the present moment too, from a price equity perspective. But it's another consideration. It's all part of the, I guess, the rich tapestry, as they say. And asset class behaviour. So even though they're taking back this excess franking credits, it's not like they're removing it altogether, right? There is still franking credits in existence, but it's whether you have the tax to offset those franking credits. Does that make sense? Mm. Yeah. So by any comparative measure, a 4.5% yield compared to cash presently at 2.6, if you're lucky on a term deposit, is still a relatively good yield. It's whether we have to. It's about managing the mix of your assets, whether they be. Well, you can look down here. Your cash and fixed interest has zero tax effectiveness, whereas Australian shares still have a high degree of tax effectiveness. International shares, low degree of tax effectiveness, and you literally have no capital growth out of any of your defensive assets. And presently, in the current economy, you're not getting particularly decent yield out of your cash and fixed interest. Would everyone agree with that? So I guess that's a very high level helicopter view, but plan well, plan early. Forewarned is forearmed. I think that's the key message. And at the end of the day, we don't know if it will pass in its present proposed format. There's a lot of water to come under the bridge, and as I said earlier, my personal opinion is that there will be a fair degree of crossbenchers, and I think that there will be horse trading because of that. So we wanted to give you a bit of a flavour of the things that we can do, what we're thinking about, and hopefully that gives you some things to think about yourself based on your own personal situation. And I included the last quote, which I always like: successful investing is anticipating the anticipations of others. Thank you.